Welcome back to Investing Talk Podcast.
Today we are looking at Rackspace Technology. And honestly, this is one of those rare situations where you have to decide if you're staring at a legacy dinosaur that is slowly going extinct
Or what?
or if we are witnessing the very beginning of an AI phoenix rising from the ashes.
A dinosaur or a phoenix?
Yeah.
That is quite the binary outcome. Usually we're talking about growth rates or margins, but this sounds existential.
It is existential. That's exactly where we are. We're looking at a company that has been beaten down to what looks like absolute capitulation levels. But just yesterday, February 18th, 2026, we got some breaking news that completely shook up the narrative.
Oh, right. The partnership.
A strategic partnership with Palantir.
Palantir.
Okay.
That's a name that definitely gets people's attention. You attach Palantir to anything these days, and, well, the algorithms go crazy.
Exactly. So what here is simple. Can a distressed legacy infrastructure company pivot hard enough into AI to save itself? Because with earnings imminent, they're reporting literally today, Thursday, February 19th. This is a critical moment.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us keep these analyses coming.
So yeah, let's set the stage. We're sitting here on February 19th, 2026. The market is waiting for these Q4 numbers. What are we looking at?
Well, if we look at the fundamentals, I'd start with a bucket of cold water. Actually, it's more like an ice bath.
Uh-oh.
If you are a growth investor, the numbers at a glance look, well, they look terrible. We are facing a significant near-term headwind. Revenue is declining. It's down 1% year over year.
Which doesn't sound like a complete disaster on its own, but context is key here.
Right. The trend's the issue. The three-year trend is down nearly 5%, specifically negative 4.77%. We're looking at trailing 12-month revenue of $2.73 billion, but they're posting a net loss of $67.1 million.
And there it is.
So let's be clear. You have a shrinking top line, and you are losing money on the bottom line. Usually that is a signal to run for the hills.
It is if you only look at the surface.
Yeah.
And I'm not denying the ugliness of the revenue shrinkage, but let me counter that because there is a turnaround thesis here that is, hiding in the details. You mentioned the net loss, which is a GAAP number.
Right.
But if we look at gross margins, they're resilient at 19.3%.
Granted, 19.3% isn't exactly software margins. We're used to seeing, what, 70 or 80% in the tech sector?
No, it's not SaaS margins, but for an infrastructure play. It proves they have pricing power. It proves they have cost discipline. Even while revenue is dropping, they aren't just slashing prices to keep customers, which is what you usually see in a death spiral.
Okay, fair point.
But the real key stat, the one that actually matters for a turnaround, is cash flow.
Okay, let's unpack the cash flow, because that is often where the truth lies in these distressed situations. You can fake earnings with accounting tricks, but you can't really fake cash in the bank.
Exactly. In Q3 2025, their operating cash flow was $91.7 million.
Wait, hold on. They lost $67 million on paper on the net income line, but they generated over $90 million in actual operating cash.
Precisely. And that is the massive disconnect. Unlike a lot of distressed companies that are just burning cash to keep the lights on, think of all those unprofitable tech startups that constantly need to raise money. Rackspace actually converts revenue to cash very efficiently.
If we annualize that.
If you annualize that $91 million, you're looking at a free cash flow capability of over $160 million.
That is a significant number. But is it enough?
It's massive, especially when you consider the valuation, which we will get to in a minute. But that cash flow gives them breathing room. It's the fuel they need to pivot. It means they can pay the electric bill and the interest payments while they try to execute this new strategy. And that brings us to the moat.
See, I struggle with the moat argument here. It's 2026. Everyone is moving to AWS or Azure directly. Why would anyone stick with a legacy provider like Rackspace? It feels like inertia, not a moat.
Inertia is a powerful moat if moving costs you $10 million. We call it switching costs, and in hybrid cloud, they are astronomical.
So their customers are trapped.
In a way, yes.
Yeah.
Once you're embedded in Rackspace's ecosystem, moving those mission-critical workloads is a nightmare. It's expensive, it's risky, it causes downtime. CIOs get fired for downtime.
Right.
So the customer base is stickier than you might think. But that's the legacy moat, the new catalyst, the moat-building opportunity is what happened yesterday, the Palantir partnership.
Okay, let's dig into this. Because every company on Earth is announcing an AI partnership. Is this real, or is it just a press release to pump the stock before earnings?
That is the cynical view, and usually I'd agree with you, but this isn't just some marketing gimmick. They are partnering to deploy Palantir Foundry and AI platforms. And here's the nugget people are missing.
What's that?
Palantir deals with sensitive government and enterprise data. You can't just throw that onto a public AWS server sometimes.
Right, data sovereignty issues,
Yeah.
security clearances,
Mm.
all that stuff.
Exactly. You need air-gapped or private cloud environments. Rackspace is the legacy king of private cloud. So this isn't just Rackspace reselling software, it's Palantir needing a secure private infrastructure partner to deploy their AIP, their artificial intelligence platform, for clients who legally cannot use the public cloud.
So Rackspace becomes the safe house for Palantir's data.
Essentially, they become the deployment partner in the AI infrastructure boom. They are taking that legacy infrastructure expertise, which everyone thought was deadweight, and applying it to the hottest sector in the market. It positions them right at the intersection of AI and multi-cloud.
That is a compelling narrative. I can see the logic. Palantir brings the brains, Rackspace brings the secure bunker. But I have to bring us back to the financial health because we cannot ignore the balance sheet. It is, well, it's frightening.
It is leveraged, yes.
Leveraged is putting it politely. I'm looking at the liabilities here. Total liabilities are $4.03 billion. Total assets are only $2.84 billion.
It's a stark picture.
Let's actually visualize that debt pile for a second. In a standard liquidation scenario, if they close the doors today, shareholders get zero. Actually, they get less than zero. The debt to equity is negative 234%. That suggests the market has priced in maximum distress. They are completely underwater.
They are, but, and this is a big but, they did pay down $41.5 million in debt recently. And going back to that cash flow, as long as they can service the debt, which that $91 million in quarterly cash flow says they can, they aren't going bankrupt tomorrow.
So it's a zombie, walking dead.
No, it's an option. The negative equity is scary, but it also means the stock is priced as if it's already dead.
Yeah.
If it survives, the repricing could be violent. You're buying the option on whether they can survive the debt maturity wall, and the cash flow right now covers the interest.
That's a fair point. It's priced for bankruptcy, so just survival is the upside surprise. So fundamentally, we have a company that is printing cash but drowning in debt. Usually that leads to a messy stock chart. Let's pivot to the charts.
Well, yesterday was the spark, the pop. When the Palantir news hit on February 18th, the stock finally woke up. It broke above its 52-week low of 41 cents. Currently, we're hovering right around 42 cents.
Just barely off the floor. It's basically trading for loose change.
Barely. But it broke the low. That is significant.
It is, but let's zoom out to the trend. This has been a capitulation washout. I mean, looking at the yearly chart, this thing fell from a high of over $3 all the way down to 41 cents. That is a brutal, relentless sell-off.
It has been a falling knife, for sure. You try to catch it, you lose a finger.
And looking at the moving averages, we are deep in oversold territory. The stock is trading way below the 50-day simple moving average, which is at 89 cents. And the 200-day, that's up at $1.17. We are miles away from those trend lines.
Which, to a technical trader, just screams mean reversion. The rubber band is stretched so far to the downside that it wouldn't take much to snap it back toward that 50-day line.
A dead cat bounce.
Even a dead cat bounce to the 50-day moving average is a 100% gain from here.
Maybe. But we also have to talk about volatility. The beta is 2.18.
Meaning it's more than twice as volatile as the overall market.
Exactly. If the S&P moves 1%, this thing is moving 2% or more. That means massive swings. If you're in this trade, you have to be ready for your portfolio to whip around. This isn't a set-it-and-forget-it dividend stock.
It's not for the faint of heart. But that volatility works both ways. If the Palantir news catches fire, that beta of 2.18 means the upside move will be explosive. It amplifies the bull case just as much as the bear case.
True. High risk, high beta.
Yeah.
All right, let's shift gears and check the market pulse because the sentiment around this name is just fascinating.
It really is. Right now, the sentiment is driven by one single factor, the Rackspace Palantir strategic partnership. That is it. That is the only material news catalyst we have. Everything else is just noise.
So the market is entirely focused on this one lifeline.
Yes. But here's the most fascinating data point I found in the research. The analyst disconnect.
This stood out to me too. Break it down for me because it looks like a complete contradiction.
Okay, so the average rating on the stock from analysts is reduce. They are telling you to sell or reduce your position.
Okay, that's standard for a distressed stock with negative equity. Makes sense.
But the average price target is $1.51.
Wait, say that again? The stock is at 42 cents.
Exactly.
So they are saying reduce, but their price target implies a, what is that?
A 259% upside. It makes absolutely no sense on the surface. Buying at 42 cents with a target of $1.50 is a potential multi-bagger. Even the bears, Like Royal Bank of Canada, they have targets of 175.
That is just wild. Why would they do that? What's the logic?
This is a classic career risk dynamic for analysts. Imagine you're the analyst at RBC. The math says the stock is worth $1.75 based on that massive cash flow we talked about. But if you slap a buy rating on a company with negative equity and they go bankrupt next quarter, you lose your job. You look like an idiot.
Ah, I see. So you're covering your bases.
Exactly. If you rate it reduce but keep the price target high, you cover your backside. If it goes up, you point to the target and say, see, my model was right. If it goes to 0, you point to the rating and say, I told you to reduce. They are hedging their reputation.
That is incredibly cynical, but it makes perfect sense. And that gap, that fear, is where the opportunity lies for the retail investor who doesn't have a boss to answer to.
That's it. The math implies the stock is undervalued, even if the sentiment is officially negative.
And who's holding the stock while all this is happening? Institutional ownership is at 82.5%.
That is an incredibly high concentration.
It is. It suggests the smart money, the big funds, the asset managers, they're holding the bag or they're positioning for a turnaround.
Yeah.
Don't usually see 80% plus ownership in a company that is guaranteed to go to 0.
Right. If they thought it was going to 0, they would have gumped it already. They have better information than we do.
And I noticed there was some recent insiders selling, and EVP sold about 2.31% of their holdings. But honestly, compared to that massive institutional stake, it feels negligible.
It's noise. 2% is tax loss harvesting or portfolio rebalancing. Maybe they needed to buy a house. It's not a vote of no confidence. The real story is that 82% of the float is locked up with institutions who are waiting for something to happen.
Okay, we've covered the upside, the Palantir narrative, and the weird analyst math, but we have to be responsible here. We cannot let people walk away thinking this is a sure thing. Let's look at the risks. What's the bear case?
There are definitely risks, massive ones.
Risk number 1 for me is structural decline. We talked about the Palantir partnership, and it sounds great, but what if it's just PR fluff? What if Palantir just signed it to get a headline and never actually pushes any real volume through Rackspace?
That is a very real possibility. Implementation risk is huge.
If that partnership doesn't translate to real dollars and revenue continues to contract at -1% or worse, the stock is going to retest that 41-cent level. Or worse, it breaks through and goes into price discovery on the downside. The legacy business is shrinking. That's a fact. We can't wish that away.
It is. If the AI pivot is smoke and mirrors, the legacy decline just drags them down. The phoenix never rises, it just turns into a pile of ash.
And risk number 2 is the debt trap. We mentioned the liabilities. With net margins at -10%, they have zero margin for error. It's a margin cascade. You start with that decent gross profit, but by the time you pay for operations and service that massive debt pile, you're in the red.
It's a precarious position. One slip up, one bad quarter where cash flow dries up or interest rates spike again, and that debt becomes an anchor that pulls them under.
Exactly. It's a tightrope walk over a canyon.
But here is my rebuttal to the debt trap argument, and this is the most important number in this entire analysis. It comes back to the cash flow versus the valuation. We said they are generating $160 million in annualized free cash flow.
Right.
Do you know what the current market cap is? The total value of all the shares.
It's around 40 cents a share, so
Maybe $100 million.
it's $103 million.
Wait, say that again. The company generates more cash in a single year, $160 million, than its entire stock market value of $103 million.
That is absurd. That shouldn't exist in an efficient market.
It is fundamentally disconnected. The downside is capped in a way because the business is printing cash faster than the market is valuing the equity. You are paying less than 1x free cash flow.
That puts it in perspective. You're buying a money printer for less than the cost of the money it prints in a year, assuming the printer doesn't break down.
Exactly. You were saying the market is pricing it as if the cash flow is going to disappear, and if it doesn't, the repricing has to happen.
It's an asymmetry. You're risking 42 cents to potentially make $1.50 or more. The risk-reward is skewed heavily in favor of the bulls, provided they don't go bankrupt in the next 12 months.
That's the entire thesis.
All right. You've made your case. It's time for the verdict. What are we doing with Rackspace?
Okay, looking at everything, the Palantir catalyst, the absurd cash flow valuation, the oversold technicals, I am giving this a bullish score of 6.5 out of 10. 6.5. That is cautiously optimistic. It's not a table pounder, but it's interesting.
It is. The thesis is simple. This is a high-risk, asymmetric reward trade.
Yeah.
It is a distressed infrastructure play that is positioning itself at the intersection of AI and multi-cloud. You are buying a dinosaur that is learning to breathe fire.
I love that image. So how do we trade it?
The horizon is a swing trade into earnings, literally today and next week. We are watching for the Q4 earnings guidance, specifically on the Palantir monetization.
What's the key catalyst we're listening for on the earnings call?
We need management to say this partnership is going to drive X amount of revenue in 2026. We need a number. If they give us positive guidance on that, the targets are a move toward $1 or even $1.50.
That's a potential triple from here.
Yes. But you absolutely need a stop loss. I would set it at 35 cents. That is below the 52-week low. If it breaks 35 cents, the thesis is broken, the market has rejected the turnaround, and you get out.
Smart. Protect the downside. Don't marry the stock.
So to recap, we have high leverage and shrinking revenue, which is terrifying. But we have massive upside if this AI pivot works, backed by a partnership with one of the biggest names in AI, Palantir, and the stock is trading for less than 1 year's worth of free cash flow.
That is the verdict on Rackspace. It is not a safe stock, but it might be the most interesting trade on the market right now. Make sure to subscribe, like, and comment to support the show. Let us know if you think Rackspace is a buy or a bust down in the comments.
Thanks for listening, everyone. We will see you next time.